Good afternoon. I'm Susan D'Antoni, the CEO of Montgomery County Medical Society, and I want to welcome you to another webinar in our series to assist you and your practice to respond to the continuing challenges and opportunities of COVID-19. Just a few reminders before we get started. This call is being recorded, and we will post it online on our YouTube channel for all of our practices to access later this week. We have muted participants in the beginning of the call for sound quality purposes. To mute or unmute yourself over the phone, press *6. On a PC, Alt plus A. On a Mac, Shift plus Command plus A. We encourage you to note your questions in the chat feature. We will pose those questions at the end of the presentations. Today, our presentation is entitled COVID-19 Financial Relief Update, Employee Retention Tax Credit, and PPP Loan Forgiveness. While PPP 2.0 has received the most attention in the recently passed stimulus bill, there are other parts of the package that you may not have yet heard about. In this webinar, we will hear from Ryan and Wetmore, a regional accounting, tax, and consulting firm, about lucrative tax credits that your practice could be taking advantage of retroactively in 2020 and 2021. Many PPP borrowers are now eligible to receive thousands of dollars in reimbursements through the Expanded Employee Retention Credit, or ERC. Bring all of your tax relief questions to this event later after the presentations. The learning objectives today are you will be able to describe relief aid for medical practices provided in the most recent stimulus bill. You'll be able to explain the applicable rules and IRS guidance and form strategies to maximize both the employee retention credit and PPP loan forgiveness. Our presenters are Peter Ryan, CPA, MBA, founder Ryan and Wetmore; Chloe Parker, CPA, MBA, manager of Ryan and Wetmore; Jack Ramsey, finance consultant with Ryan and Wetmore; Tu Nguyen, a senior finance consultant with Ryan and Wetmore. Thank you all for joining us today. We thank Peter, Chloe, and Jack, and Tu, and are looking forward to their presentations. And now we'll turn it over to Chloe.
Good afternoon. We're very excited to be here. I think our slides are coming up right now. As Susan mentioned, this is potentially a very important credit for medical practices as far as claiming it and using this in addition to the PPP funding or in place of if you didn't qualify for the second round. So a lot of people have overlooked this, and there's been a lot of changes both in December and this year that have expanded the program. And we really hope that today's presentation will help to explain how it will be able to benefit your practice. I want to quickly tell you a little bit more about our team. We have Pete with us, one of our partners.
Hello, welcome everybody. Happy to be here. I co-founded Ryan Wetmore. We started in Silver Spring in 1988. We've grown to between 40 and 45 team members, mostly CPAs and consultants. We also have a group of people that just, that are not CPAs, that just help clients solve business problems. They're MBAs and finance majors. And I, at 27, I was running a hospital, nursing home, and an physician practice. So I understand all the intricacies of running a medical practice. Well, I'm happy to be here today. Thanks.
We also have Tu with us.
Sorry, Chloe. Hi, everyone. I'm Tu. I'm a senior finance consultant in Ryan Wetmore. I've been with the firm for about 5 years, working on a wide range of clients and helping them with business consulting projects. I primarily focus on healthcare providers. I'm happy to be here with you all today.
Thank you. I'm Chloe Parker. I'm a CPA, and I work closely with growing businesses, a lot of physicians who have started their own practices, as well as other industries. with either financial statements, tax returns and tax planning, and also day-to-day operations, creating a sustainable structure for growth tax planning and knowing where your money's coming in and going. And finally, we have Jack with us today.
Hi, I'm Jack Ramsey. I'm a finance consultant with Ryan Wetmore. I've been working directly with our clients and employers, helping them take advantage of the many relief programs that have occurred during the pandemic, and also building models to maximize and optimize relief across those programs.
So included here is a group of organizations we're part of. So we're part of the Montgomery County Medical Society. We're part of MGMA. We're a part of ATA, which is a group of 85 CPA firms that just specialize in healthcare. We're an independent member of the BDO Alliance. I'm also actively involved in the BDO healthcare group, okay, made up of about 50 firms around the country. And I co-founded the DC chapter of Alliance of Mergers and Acquisitions that's focused on exit planning. And we've had a number of groups, especially some derm groups that have been rolled up. So M&A is a big part of healthcare today. So, that just gives you an idea of our background.
For today's presentation, we'll walk you through what the employee retention credit is and the legislative history, which has been changing very rapidly. We'll also walk you through eligibility, from who is eligible and how you are eligible to how much you could potentially qualify for. We'll also go over some parts of the credit that are unique to the healthcare industry and how the government shutdowns have affected that. And then we'll also go over how this interacts with other types of funding that you may have received, such as the PPP loan or advance payments. We'll also talk about self-employed businesses and then go into some of the documentation requirements and next steps for claiming the credit. And we will have time for questions at the end, so please keep those coming in if something doesn't quite make sense or if it perks your interest in something.
So let's start out with a bit of a clarification on what is ERC. So ERC is the Employee Retention Credit. It is a fully refundable tax credit, not a loan or a grant program. It's not related to PPP. And in fact, PPP borrowers are now eligible even retroactively to claim the ERC. So the refundable part means that if your employee retention credit calculation is actually greater than your total tax liability, greater than your Social Security tax liability, your employer's Social Security tax, that excess is actually refundable overpayment. So it essentially reimburses employers for qualified employee wages. We'll get into that. And as I said, it nets against your employer's Social Security tax. So even employers with no taxable income can receive the ERC. That's kind of a misconception that we've seen. So everyone's potentially eligible, even if you have no tax liability, but we'll get into some of the eligibility criteria later. And it's now, with the passage of the American Rescue Plan, been extended through December 31st, 2021. So now all of 2020 and 2021 are potentially eligible. So to quickly get into the legislative history, the ERC was originally passed with the CARES Act back in March 2020. And it was supposed to encourage economically impacted employers to keep employees on payroll. So that led to a bunch of people wanting to claim the employee retention credit. However, originally, it was not available to PPP borrowers. You had to choose. So at the end of 2020, just before the $900 billion stimulus bill passed, many healthcare organizations were taking advantage of PPP and PRF or ERC and PRF. But once the CAA, that $900 stimulus bill passed in December, organizations became able to retroactively claim ERC and benefit from a combination of all of these relief programs. And most recently, on March 11th, 2021, the American Rescue Plan was passed, which again extended the ERC for 2 more quarters and slightly improved it.
So there are 2 ways to be eligible for this credit, and this applies to employers of any size. And the first one is if you were fully or partially shut down by the government due to an actual government order related to the pandemic. And Chu's going to get into in a couple of slides what this means for healthcare providers, because a lot of healthcare providers did face these partial shutdowns. Or scenario 2, if you had a significant decline in gross receipts in any quarter of 2020 compared to that same quarter in 2019, or a 2021 quarter compared to that quarter in 2019. And those requirements are slightly different between the 2 years, so we'll walk you through those later as well. But either one, it doesn't have to be a both and, it's one or the other. As far as eligibility, this is also different for 2020 and 2021. So for 2020, it was up to $5,000 per employee, and that was calculated at 50% of qualified wages, and qualified wages were capped at $10,000 per employee for all of 2020. For 2021, that goes up to $7,000 per employee per quarter. So it's 70% of qualified wages capped at $10,000 per employee per quarter. So potentially up to $28,000 for an employee for the year. Qualified wages in this example include gross wages subject to Social Security taxes and group health care benefits paid by the employers. And as Jack just mentioned, as of the beginning of this month, it has been extended all the way through the end of the year.
So Chloe and Jack just talk about the overview of ERC and how you can be eligible for ERC. And in this slide, I want to focus more on how ERC can be applicable to the healthcare industry. There are 2 main ways you can qualify for ERC. Either you were shut down by the government or you have a gross receipts decline. So any businesses that were shut down are eligible for ERC during the period that they were shut down. In terms of the revenue decline, if you qualify by having a decline, then you qualify for the entire quarter of that gross receipt decline and possibly the subsequent quarter as well. In terms of, for a lot of healthcare providers, in terms of gross receipt, there's a lot of special considerations that you have to look at because many healthcare providers receive provider relief fund. So based on the IRS FAQ that they just released, the PRF is considered gross income. So when you calculate that gross receipt in 2020 versus gross receipt in 2019, you have to take that PRF payment into consideration. The Medicare advance payments and the PPP loan forgiveness are not considered gross receipts. So because of the PRF payment, many healthcare providers might not hit a big enough gross receipt decline in 2020. So, but then you can also qualify for ERC by having a shutdown. We run into a lot of situation with our healthcare provider client is that they have been deemed essential businesses. So they ask us, how can they qualify for a full or partial business suspension? So to be considered qualified by being shut down, there are 3 main criteria you have to look at. Number 1, you were fully or partially suspended by a government order. And in the next slide, we would go into more details into what it means by a government order. The second criteria was if you were affected more than a nominal share of your company's business. And we would obviously go into more details what it means by a nominal share. And thirdly, you were prevented by the order from operating at the same level of service as before. And this has to do with telework, telemedicine, and we would also go into more details of this. So firstly, what qualifies as a government shutdown? It has to be an order from the federal government or any state or local government. a statement from a government official is not considered a government shutdown. A CDC recommendation is also not considered a government shutdown. And it's very important for healthcare providers or physician practices to document all the relevant government orders that you receive. If you receive multiple orders, you should pay special attention to orders that give you a longer period of shutdown, or look at the order that is the most restrictive. Here, we talk about what it means by a nominal share. We understand that the definition is, the term itself is very vague. So IRS put out an FAQ number 34 that addressed what it means by a nominal share. If your businesses were closed by a government order for only certain purposes, but remains open for other purposes. So it's only operational for limited purposes. It's very helpful that the IRS also put out an FAQ with example. Let's say that you are a hospital that operate both essential and non-essential businesses. What it means is your essential businesses, you have emergency department, you have intensive care unit that were allowed to be open because those are considered essential, but your elective and non-urgent medical surgeries were suspended because those were considered not essential. So if your elective and non-essential procedures were suspended and those are nominal share of your businesses, you may qualify for the ERC. And at this slide, we go into more example of what it means to have a full or partial suspension of operations. Let's say you were restricted in the number of hours that you can be operating by a government order. For example, pre-COVID, you were allowed to operate for 8 hours a day, but because of COVID-19, you got a government order that require you to do deep cleaning every hours. So your hours of operation were limited to 5 hours a day. So that would be considered a partial shutdown by the government. The second example is, let's say that you are considered essential businesses, but your PPE suppliers were not considered essential and they were shut down by the government. And because of that, you have trouble or you were unable to obtain PPE to support your services, then you were also considered to be partially shut down by the government.
And, this is for our medical clients, this is some of the most difficult things to determine, to get the credit. And sometimes it's really easy to determine, the day we were partially shut down, but then gradually you added more services. And then you kind of get, well, when's the end date for that partial shutdown? So the lines get a little blurry here. And so it's sort of a facts and circumstances. We're happy to discuss some of them, or you can email us with certain questions. But, for a lot of clients, there's not necessarily a bright line. For some of our dental practices, there was a bright line. You're now allowed to be open. But for other dental clients, you're open on a limited basis afterwards. I don't consider emergency surgeries to be open. So this is a hugely gray area for the healthcare industry. So we talked a little bit about what's the big difference between 2020 and 2021. So to put everybody to summarize everything that, Chloe had mentioned this in a few slides. In 2020, when PPP happened and COVID-19 happened and the PPP loans came around. If you got a PPP loan, you were not eligible to get, an ERC tax credit. And so it's sort of, for most of our clients, it stopped right there. We weren't worried about it. We didn't think about anything of it. And so in 2020 versus then 2021 came along and they said, okay, you can get a PPP loan now and get an ERC credit. And so that changed the world kind of deal. And we'll talk about the other thing that changed the world. So the first thing we have on this slide is employers of any size, including tax exempt organizations, were not eligible and they are now eligible kind of deal. And there's also employers not in existence in 2019 are now eligible for the employer tax credit. So that, again, it was a huge change when they passed this bill in December and they added more employers of different sizes. And one of the things is that originally, if you had more than 100 employees, you only got credit if you paid people not to work. Well, they changed that limit in 2021 from 100 employees to 500 employees, okay? And so then the other big, huge change was to qualify for the credit, you needed a 50% decline in gross revenue in 2020. In 2021, you only need a 20% decline in revenue. Again, so many more people, and you can get a PPP loan 1 and you get a PPP loan 2 kind of deal, and you're still eligible for the credit. You can't double dip. We'll talk about that. You can only count the wages for one available program. You can't count the same wages for different programs. And then there's also a special election that you can make, like you can use the prior quarter's decline in gross receipts to apply to the next quarter's wages. So like if you were down 20% in the fourth quarter 2020 to the fourth quarter 2019, you're eligible to use that decline for your first quarter 2021 wages. And so the way this sort of works, and we have a few slides that goes on, is in 2021, you're going to compare the first quarter 2021 to the first quarter 2019. I know it doesn't make a lot of sense. And if your gross receipts are down by more than 20%, you're eligible for the ERC credit. Okay. If your wages were down, for 2020, you would compare the second quarter 2020 to the second quarter 2019, and you have to be down at least 50%. In 2020, you have to do the same thing for the third quarter and fourth quarter. So again, a lot of, we continue to run into clients and referrals and people who call us up or to hear us talk, and they have no idea about this credit. It's a huge credit. Again, you're going to get 70% of the first $10,000 in wages in 2020 versus 50% of one time. In 2020, it's 50% of $10,000 one time. And in 2021, it's $70,000 of the first $10,000 in wages per quarter. So it's a huge difference, a lot more people, a lot more dollars. Like if you have 40 employees and you're eligible for the credit, that would be 40 times $7,000, assuming they all made $10,000 in that quarter. That's $280,000. And so I just sort of, rehashing this. In 2020, it's $10,000 per employee. There's an annual limit. In 2021, there's $10,000 per quarter. And so it's a huge difference. 2020 is 100 employees. 2021 is 500 employees, okay? And so, again, this is the huge difference, and so again, a lot of clients are now eligible. A lot of people don't understand it. It's, again, the bill that passed at the end of summer was a huge change. And then in March, they just, extended it to the third and fourth quarter 2021.
So let's talk about some of that new bill. Besides extending it for 2 more quarters, there are some new ways to qualify in these 2 additional quarters that are now eligible, the third and fourth quarter of 2021. So number 1, a new eligible category of businesses starting in that third quarter is recovery startup businesses. So if you started up business after February 15th, 2020, and your average annual gross receipts are $1 million or less, then you are considered a recovery startup business. So for these businesses, you can qualify in that quarter. However, your total credit has a cap of $50,000. And another group that's targeted for additional relief are severely financially distressed employers. So these are businesses that have a 90% decline in gross receipts instead of just that 50 or 22% decline that Pete was talking about. We don't know a lot of businesses that are going to qualify this way, but if you do qualify this way and you are a severely financially distressed employer, you're not subject to those size requirements, and you can just count any wages paid to an employee during any quarter. And of course, these changes only apply in the third and fourth quarters of 2021. They're not retroactive. So let's talk about the interaction of PPP, PRF, the Provider Relief Fund, and ERC. So can you do all 3, or can you combine multiple programs? The answer is definitely yes, and we have a lot of clients that are doing that. So PPP borrowers can now claim ERC, even retroactive, so you can go back and claim it in 2020. However, people that accept PPP or PRF as well as ERC should be careful not to double count their payroll costs. So this also applies to FFCRA emergency paid sick leave and family medical leave credits, which got extended further by the American Rescue Plan. and also provider relief fund reimbursements, as I just said. You can't simultaneously use these programs to pay the same payroll. That's really important. And it's something we see a lot of clients struggling with when they try and calculate these themselves. So PRF is flexible to use anytime in 2020, and it must be expended by June 30th, 2021. So let's talk about some best practices. If a borrower has not yet applied for a PPP loan, you may want, for a PPP forgiveness rather, they may want to allocate the maximum permissible cost amount of non-payroll costs for PPP loan forgiveness. So you'll recall that for PPP forgiveness, you have to spend 60% on payroll, and you can spend up to 40% on non-payroll costs like utilities or rent, as long as it's not paid to a related party. So by allocating 40% of your loan proceeds to those non-payroll costs, borrowers can increase their potentially eligible ERC wages. So another thing is with the American Rescue Plan and other changes, such as the CAA, the forgiveness covered period for PPP loans is now flexible. So it can be 8 weeks, 24 weeks, or anything in between. That has a bunch of effects on PPP calculations, including FTE decline calculations and the penalty you'll have to forgiveness for that, and wage declines, and if you get a penalty for that, and you can potentially minimize those declines by adjusting your covered period. And that will also impact your eligible ERC wages. You also need to consider documentation to show that you're not double counting the same wages for PRF, PPP, and ERC. So let's look at another recent IRS update on the interaction with PPP forgiveness. So the background on this is that AICPA, the American Institute of CPAs, sent a letter to the IRS asking that they allow companies to use wages on PPP or on ERC rather, as long as, even if they put them on their PPP forgiveness application, as long as they didn't need those wages to get full forgiveness. Basically what the IRS said is, yes, that's okay. So if you submitted a PPP forgiveness application with more wages on it than you needed to get that full forgiveness amount that you got, you can potentially use those wages on ERC, provided that they're otherwise eligible. So the no double dipping rule definitely still applies. You have to make sure that you didn't need those wages. So there's some complicated calculations with that. So how do you maximize relief from multiple programs, considering that you can't double count wages in multiple programs? So that presents a complicated challenge to a lot of companies. So for many programs, FFCRA, ERC, PRF, PPP, a whole alphabet soup of programs, you can't double dip between them. So you've got to make sure that you don't violate these rules. That's really important. So what we do to give you an idea of how we bridge these problems is we build complicated models for our clients, especially larger clients who participate in multiple programs. A lot of times that's our healthcare clients. You know, in these models that affect the calculations, you need to compute monthly average FTE, full-time equivalent, your average wages and how much those declined, qualified wages for ERC, reduction in hours, etc. All of those things need to be computed in an integrated model if you want to maximize forgiveness across these programs. That's what we do for our clients, and that's how we provide an integrated approach to maximize forgiveness in PPP, ERC, and others.
So as we're thinking about this and how to maximize it, one of the interesting challenges people have had is, what about people who are self-employed? So typically you think of a self-employed person as someone who's a partner in a partnership, a shareholder in S Corp, or has a Schedule C. So you are allowed to claim this credit for your employees who are not yourself or are not related. So unfortunately, the IRS is not going to give you a credit for retaining yourself. But if you file on a Schedule C and you have employees, or any of the other partnership S corporation, you should still be able to claim that for your employees who are not yourself or are not related to you. We also want to talk about the documentation. So as Jack was getting into, it can get quite complex as you're looking at, hey, how am I going to maximize all of this? So you want to have the right things in your file to be prepared for this. So the first thing is you want to make sure that you're eligible. So if that's via the shutdown order, make sure that you have a copy of that for your records. If it's via gross receipts, you want to have a copy of that calculation. That can often be pulled from your accounting system fairly easily. You want to make sure that you have qualified wages. A lot of the payroll companies are offering reports showing qualified wages, and you can set the period for that. And then it's kind of down to allocating those wages, how much was PPP forgiveness, how much related to the PRF, and how much was any of the other credits. For large employers, if you're going to go the route of paying people who weren't actually working, you would want documentation that that is what you did. You want documentation of your health plan and how much of that is qualified expenses there. If you're part of an aggregated group where you have ownership interest in multiple organizations claiming credits, you want to take a look at that and make sure that you are in line with any rules there. And then, of course, you're going to need copies of your typical tax forms, Form 941, Form 941X if you're amending 941s, and Form 7200 if you're claiming advanced credits. So there's a couple different ways to claim. If you are going back to 2020 and saying, hey, because of these new rules passed in December, I would qualify for 2020, you want to go ahead and amend that on a 941X. And this is where you would want to coordinate between your CPA and your payroll provider and your office administration to how much of those wages qualify. If you are claiming for 2021, you have a couple different options here. The first option is you wait until the end of the quarter and file a 941X. The second option is you are eligible to start claiming the credit and stop making tax payments now related to that 941 tax if you meet the eligibility requirements. So if you are in a cash crunch, this is huge. So you don't have to wait for the IRS to give you money back. You can stop remitting. However, you want to be really sure about that so you don't end up with a liability later. And if you are really in a cash crunch, you can actually apply with the Form 7200 for an advance of that credit. So that, I believe, too, was talking about how if you exceed the amount of tax that you pay in the form of that credit, you can get money back from the government and you can apply for that now. So this is really big if you need cash now and are trying to continue to finance and stay in place. The idea behind this credit is the government's really trying to keep people employed, keep businesses active. So as we recover, people are working, people can go back to the doctor. We have infrastructure in place.
So I guess the next question is, what are the next steps kind of deal? And this gets kind of complicated. We build models that, some models are rather simple, some models are really complex. So the first thing to do is sort of talk to a trusted advisor, okay? So that's the first item of business. Next item is determine your accounting method. Most of our medical practices are on the cash basis. Unless you're more or less over $25 million, then you might be on the accrual basis. You could have checked the box to be on the accrual basis, but this is going to be the determination for whether your revenue is declined in 2020 compared to 2019 or in 2021 compared to 2019. So the next step is rather arithmetic. You just go compute your revenue from first quarter 2019 to first quarter 2021, see what the decline is. If it's more than 20%, you're eligible. And then you're going to compute the second quarter 2020 to to the second quarter 2019 and see if it's a 50% decline. You're going to compute the second quarter 2021 to the second quarter 2019 and see if you're a 20% decline. Okay, this is rather straightforward. So you just have to do the math kind of deal. And then you have to know what is revenue. We talked about, provider relief funds are revenue, PPP is not revenue. And, advanced Medicare funds that just showed up in our clients' bank accounts without any prior notice, that's not revenue. And the next thing is probably the crucial thing, were you subject to a government shutdown, either partial or full, and then define when that shutdown was. Find all your shutdown orders, because so we're just determining eligibility. If you're eligible, the next thing you do is obtain all the payroll information for the eligible quarters in 2020 and 2021. So depending on, there's, again, if you've gotten the 3 or 4 different funds, if you got provider relief funds, PPP funds, okay, you got to figure out, okay, you can't double dip. This is where you determine, okay, which wages are going to be used for which period. And there's different eligible requirements for 2020 and 2021. So then you have to determine which payroll periods to use. And then you file amended returns for the applicable quarters. We generally think, most of our clients have some kind of shutdown in 2020. And so then you would qualify in 2020. You don't have to be down 50% if you have a shutdown. And then, the government gave you 24 weeks to pay 8 weeks of payroll. So if you kept the same number of employees employed, this is just a hypothetical example, you should, when you file your PPP application, you should have, what we, Jack and I and Chloe call excess payroll kind of deal. And so you should be able to use this, the period you were shut down, you should be able to use those funds, okay, for ERC credits. Most of our clients for provider relief funds, they're using something other than payroll. It's not our first choice. But again, you have to have this all documented, and you have to make sure you don't actually dip. So once you file for the amended return, you sort of just wait for the money. It can come in 45 to 60 days later. Here is so if you were, if you had 10 employees and they all made just, say simply $40,000, okay, and you were going to get a credit of $7,000 per employee, the credit would exceed the amount of withholding tax you do. So the way the credit works is, so you reduce your payroll tax deposits by the amount of your credit. We can work with you and your payroll company to determine how to do that. But some clients have more than that amount of money because, they don't have a lot of high wage earners kind of deal. And so if you have more than that amount of money, you fill out Form 7200. And generally speaking, in 45 to 60 days, that will give you the excess in addition to your payroll taxes, you're withholding federal payroll taxes in a form of a check. All right, things to avoid, okay, not having a plan. Okay, so that's a big, not integrating your approach, not having a documentation, not considering PPP loan when applying for the ERC credit. Okay, again, you can double dip. If you double dip, that's fraud. Okay, lack of communication between the PPP and ERC advisors. Okay, we run into a bunch of scenarios where you call the payroll company and they just tell you, oh, we'll handle this, don't worry about it, we'll compute the credit. And they have no idea what you put on your PPP application. They have no idea what you put on your provider relief application. And they think they're doing a great job because they got you some credit, okay? And you realize that you've double dipped and then you have to give the money back, or you're worried about fraud. Lately, we've been seeing a lot of excessive fees out there, like third-party providers are charging 30% to compute the credit. And so, they're charging a 30%. So like an example I gave earlier, if you got a $280,000 credit, they're going to charge you like $90,000 to go compute the credit. And it's not even going to take them 50 hours or 80 hours to do it kind of deal. So you can go figure out how much an hour they're getting paid. Not claiming all applicable quarters, people not realizing what's actually going on. Not reconciling any advance payments they've gotten to the actual 941. That is some of the things we need to do, and make sure you do that.
So for everyone's benefit in this presentation, we are going to send out a recording of this and the slides. we put together an eligibility flowchart because there's a different eligibility test for 2020, a different eligibility test for 2021 Q1 and Q2, and a slightly different one for 2021 Q3 and Q4. So this is for 2020. I'm not going to go over these. We've pretty much already gone through all of the eligibility requirements. So this would be 2021 Q1 and Q2. This would be Q3 and Q4. So again, feel free to review these once we send out the slides and the recording.
Awesome. So we want to take a minute to take any questions. So if you have any questions, please submit those in the chat. We do have a couple that we're going to go over, but I did want to just make kind of remind, we're a Bethesda-based firm, like Pete said, with 30 to 35 professionals who are working on these issues closely with our clients. If you happen to have some friends over the river in Virginia, we also have a Vienna office and an office up in Frederick, Maryland. So we are working with clients on all of these issues that Jack mentioned, of kind of following those flow charts, allocating those wages, and really making sure that we are doing our part in this COVID environment to make sure that people have access to the cash flow, have access to the government relief programs that they're qualified for. So if you got any questions, please put them in the chat and we'll go ahead and go over a couple items that came up while we were before. I think, Jack, you were going to take the first question.
Yeah, so the first question is, my wife is a salaried employee. Are we eligible for the ERC? So for ERC purposes, you've got to consider who the owners are. And so for ERC purposes, owners are defined as people that own over 50% of a company, or the aggregated group of companies, either directly or by attribution. So if this person hypothetically owns over 50%, then their spouse would also own over 50% by attribution. So both of them would actually be considered owners. However, there's some gray areas here. So the IRS has not actually clarified whether normal W-2 wages, so like a salary of an owner, is potentially eligible for ERC. We talked about how self-employment earnings are not eligible, but for normal wages, the IRS has not specifically addressed the issue. However, they have said that self-employment earnings are not eligible, and the wages of the relatives of, like, for instance, siblings of the owners are not eligible as well. They've said that those are not eligible. So given the ambiguity, we think that this calls for a conservative approach. And so our current approach is that we don't count owner wages. However, if the IRS comes out and clarifies this later, stay posted for that.
So the next question we had was, who should be applying for this? And Pete kind of spoke to this a little bit earlier, is it needs to be an integrated approach. You don't want one person applying for PPP forgiveness with wages and the payroll provider using those wages for ERC. So we recently got brought in by a company and they said, you're going to be the supervisor on this. We need someone who's calling the shots to say that, yes, this is here, this is there, and kind of looking over all of that. So your CPA could do that. If your office manager understands this, he or she may be very qualified to do that, but you need to have somebody who's leading that coordinated approach. And so that's going to go from practice to practice. We also, so we talked a little bit about the declines in revenue. Like we said, it was either a decline or a shutdown. So you can go through Jack's flow chart, or we're happy to talk after individually about some of those. And then or Jack, did you want to speak to question number 4? And I know we have some questions coming in the chat as well.
Jack, you can go ahead about question 4. There was some follow-up question to your answer to one later. We can talk about that later too.
Okay. So question 4 is we have over 100 employees and we had to furlough some, but reactivated them after a few months. Are we eligible for ERC? So the short answer is yes, subject to the eligibility requirements that we talked about earlier. So some considerations here is that if you had over 100 full-time employees on average in 2019, you're going to face some additional restrictions in 2020 for the ERC. So you can only claim that on employees that were paid while not providing services. So if you paid these employees while they were on furlough, assuming that they still got paid while on furlough and that this wasn't already reimbursed by another program, it wasn't part of an existing like sick leave arrangement. So if you paid employees during that time, that's potentially eligible. If you paid for their group health plans during that time, those health payments are potentially eligible. So keep in mind that for 2021, that 100 employee threshold has been loosened to 500 employees. So depending on your average full-time employee count in 2019, you may not be subject to those additional requirements anymore for the 2021 ERC.
To go over what Jack was saying, based on the question that's in the chat room here, 100 employees just applies to 2020, not to 2021. 2021, it's 500 employees. So.
Okay, so let's go over some of the chat questions now. I know there was a follow-up question about a spouse who is employed. At this point, we do not believe that ERC credits could be used for a spouse's wages.
I guess the question is, the spouse a physician owner?
Right, if it's the spouse of a physician's owner. So if you are the owner and your spouse is getting paid, we don't believe that would qualify. If you and your spouse just happen to work at the same company and you guys don't own the company, you would both have qualifying wages. There were a couple questions about the HHS stimulus and provider relief funds and what you can use those wages for. Chu or Pete, did you want to speak to that?
Yeah, the question is the provider relief fund we are referring to the same as the stimulus payment from HHS, and yes, they are the same thing. It came in 3 phases, and for those payments, you have until June 30th, 2021 to expend them. And just keep in mind that if you expended over $750,000 in a given fiscal year, in terms of any federal relief fund, your company would have to go through a single audit. And we have a blog that write a lot about different issues when it comes to COVID, when it comes to provider relief fund on our website. You can find more information on our blog.
And two, can those PRF funds, can they be used for 1099 labor? Independent contractors instead of employees?
So the provider relief fund payment you can use for any healthcare expenses. And if you have maximized all of them on healthcare expenses, you can also use them for any lost revenue as well. Okay.
And then we also had a question from an independent physician getting paid by 1099. And I'm assuming that this is a single person operation, that this physician isn't a physician and then also paying employees under himself, but it's just himself getting paid as a 1099. Unfortunately, the employer retention credit would not apply, but there still could be possibilities for other funding.
Some of the things that might qualify, there's a 7202 form, I believe, that if you were you couldn't work because of COVID and you're an independent contractor, you might be eligible for $6,000 or $8,000 credit. We can sort of send some information on that. It's a little bit of a gray area, but if you got crushed by COVID, I would think you would meet that kind of deal. And then they changed the PPP rules for sole practitioners and last week, and so originally, so that's a huge huge benefit. You can use gross revenue now, not net revenue, to compute some of these things. And the really funny part about it is like they didn't do a great job for people who already applied for it. So that's another thing. So, but yeah, there's a bunch of programs, and Maryland is coming out with another program here shortly. It's part of the $1 billion package that got passed a few weeks ago. So we can provide updates on that, so there's a bunch of programs, and there's likely to be more, so.
Okay, any other questions that we might be able to assist with today? All right, Susan, I'll turn it back over to you. Thank you for having us.
Well, thank you very much for this really informative webinar. I think it was so well done. It does appear, so somebody was also thanking you for the information. This is a really important topic. It's very involved. We thank you for sending those additional resources, and we'll make sure that we include links to your website, to your blog, and to all of you. So we thank Peter, Chloe, and Jack, and Tu for collaborating with us today to offer this educational program. If you do have additional questions, you can send those to MCMS staff or to our speakers. I'm sure they'd be happy to respond to you. We will make this webinar available online via our YouTube channel, and we will make sure that you get a copy of these slides. You can also just rewatch the recording. Don't forget to subscribe to our YouTube channel for additional educational content that we've been offering since the end of March last year. So if there are additional educational programs that you or your practice needs, we hope that you'll reach out and let us know. We are open to working and collaborating with others in our community, content experts, professionals like the ones that you've heard today. And so we would be pleased to put together additional webinars. We thank you for your support of Montgomery County Medical Society and MedChi, and we hope that you have a good rest of the week. So thank you very much for joining us today.